That has reported numbers for the third quarter today. The bank maintained profit growth of 20% for the 10th consecutive quarter. Asset quality, though, has taken a slight hit. Ekta Batra, who's been doing all the number crunching now, joins us with all the details. Ekta, over to you.
Well, it was a steady and smooth quarter for HDFC Bank this time round as well. So the NII was a little above estimates, up around 24% versus an estimated 20-odd% growth, with the profit in line with estimates, which was a 20% growth, and in fact is around the 10th consecutive quarter of recording that 20% growth. Now, in terms of the asset quality, the gross NPLs saw a little bit of marginal worsening, so 0.97 versus 0.91%. It was around a 6 basis points worsening that we saw in terms of the gross NPL. On an absolute basis, the gross NPL was up around 11-odd% on a Q-on-Q basis. This compares to around a 4.8% rise in the previous quarter. However, the internals of the asset quality look good. So, for example, there was no sale of loans to asset reconstruction companies this quarter. The management did mention that there was some pressure from agri as well as SME NPLs, but there was negligible impact of the RBI's asset quality review for HDFC Bank this quarter. Now, coming to other stats, the provisions, for example, were up around 16 to 17-odd% year-on-year and up 4% on a Q-on-Q basis. Net interest margins improved 10 basis points on a Q-on-Q basis to 4.3% versus 4.2% last quarter. So that too was a tick in the box. The other income was a bit sluggish, but that was expected, up around 13.3%, with fee income, which was up around 11-odd% on a year-on-year basis. Advances strong, which were up totally by around 25-26%, led by domestic retail advances, which was strong at around 29 to 30% growth.